Today, downgrading housing forecasts fast. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, it's becoming a new sport, it seems, trying to assess the potential fall in property values across many markets here and around the world. Indeed, Christopher Joye in the AFR writes that the great Aussie housing crash is accelerating and it's being driven by the fastest and largest interest rate shock households have faced in modern history. Sydney house prices have now plunged almost 5% since their peak only months ago, according to CoreLogic. Home values in Melbourne are not far behind. The value of residential property in Australia's two largest capital cities are now declining at a very rapid pace, exceeding 1 percentage point per month, which signals double-digit losses over the next year. There is further evidence that the Brisbane market is rolling over and Adelaide and Perth prices are also looking to be grinding to a halt. If you draw a line through May 2022, when the Reserve Bank of Australia first lifted rates, you can observe a striking structural break in property prices. There was an almost immediate and quite dramatic impact on the value of bricks and mortar. After promising not to raise rates until 2024, Martin Place broke the back of the market with its decision in May and the threat of much more to come. It is not disappointed in August. The RBA will deliver an unprecedented third back-to-back 50 basis point rate rise. But let's look at another market, because property price falls are being predicted around the Western world as central banks appear at least to be coordinating rate rise increases. But before we do that, we might want to just pause and consider groupthink, which has been exhibited for at least the past 2 decades, cutting rates from 2007 and 2008 crisis, cutting them again radically ahead of COVID, to say nothing of the quantitative easing which has flooded markets with cheap money and rate control, plus handing ultra-cheap funds to banks. Now, I'll leave you to judge how independent each central bank was and is, and the degree of collusion versus common reactions to the same economic outturns. But the current mode of operation is driving highly inflated home prices, which, by the way, were driven by their earlier bad policy, sharply down as they tighten. Some would suggest the high priests of finance are not as powerful as they may like to appear. So now let's look at Canada's housing market, which has sharply shifted since the Bank of Canada began lifting its benchmark interest rates from record lows back in March. The central bank, seeking to rein in inflation that is running at its hottest in 4 decades, unveiled its largest one-time interest rate hike since 1998 last week. It raised the benchmark rate a full percentage point to 2.5% and promised much more to come. Now, the Royal Bank of Canada predicts policymakers won't stop until they hit 3.25% in October, and as a result, the housing market correction that's taking hold in Canada could turn out to be its biggest in recent history. That's according to a report released on Friday by the Royal Bank of Canada economist Robert Hogue, who says benchmark home prices could fall more than 12% through early next year from the market's peak. That would be a bigger decline than any of the 4 national downturns of the past 40 years. And they also went on to say that sales are also expected to slump 23% this year and 15% next year, and the total decline of 42% since early 2021 would outrank the 38% drop in 2008 and 2009. And he went on to say the economic landscape is rapidly becoming less hospitable for Canada's housing market, with inflation touching 4-decade highs and threatening to climb even further in the near term, despite the fact the Bank of Canada is now embarked on a more aggressive course that they believe will take its policy interest rates to restrictive levels by the autumn. This will send more buyers to the sidelines, especially in British Columbia and Ontario, where affordability is extremely stretched. The first signs of a market correction emerged soon after the bank initiated its rate liftoff in March, and they expect the downturn will deepen in the coming months, with both resale activity and home prices reaching lower levels than they previously anticipated. They project home resales to fall nearly 23% this year and 15% next year in Canada, and the national benchmark price to drop more than 12% from peak to trough by the second quarter of 2023. They expect local outcomes to vary widely, with the priciest, more interest-sensitive areas facing larger declines and relatively affordable markets showing greater resilience. And they went on to say that the Bank of Canada front-loaded its rate hike campaign with that outsized 100 basis point increase. And they think that that will speed up the market's cooling phase in the near term. While the move won't necessarily result in a higher terminal point, they still expect the overnight rate will reach 3.25% by October. That's a really big bite for borrowers to swallow that will spoil or delay home ownership plans for many buyers. The hike took variable mortgage rates roughly up to par with fixed rates, effectively shutting the last window of super cheap borrowing costs available to buyers. So, as a result, affordability is getting crushed. The rising rates are squeezing housing affordability hard. By the time the Bank of Canada is done, the Royal Bank of Canada's aggregate affordability measure could easily be at its worst ever level nationwide, with Vancouver, Toronto, Victoria, and other expensive markets leading the way. They see demand coming under increasing downward pressure in Ontario and parts of British Columbia as a result. Things will get more challenging in other parts of Canada too, albeit to a lesser degree, thanks to the relatively favourable affordability starting point and weaker interest rate sensitivities. High mortgage stress test qualifying rates will hamper stretched out buyers in every region of the country, and higher client rates will reduce the size of a mortgage and maximum purchase price qualifying borrowers can get from coast to coast. And as a result, they say there is a historic correction underway. They expect home resales will fall another 70% in Canada by early next year, after dropping 19% in the second quarter and 13% between the first quarter of 21 and the first quarter of 2022. Cumulatively, this is a 42% drop from record high levels since early 2021, and that would exceed the peak-to-trough declines of all four previous national downturns, down 33% in 1981 to 82, 33% in 1989 to 90, and down 20% in 2016 to 18. With demand weakening significantly and affordability exceptionally stressed in parts of the country, they believe prices will have to give. So they project national aggregate home price indexes will fall more than 12% by the early part of 2023, and that would also rank as the steepest correction of the past 5 national downturns. The size of the correction is likely to be larger for other price measures. The average price of homes sold in Canada, for example, would tumble by 17% or more on a quarterly basis, in part due to a shift in the composition of sales towards lower price markets and housing categories as buyers seek more affordable options. And the average price is already down 8.6% between the first and second quarters of this year, with notable declines in Ontario down 7.6% and British Columbia down 4.9%. In fact, British Columbia and Ontario will be the epicenter. Buyers in high-priced markets are especially sensitive to interest rates, and they believe will struggle the most in the period ahead. And their forecasts have home sales in British Columbia and Ontario cumulatively sagging 45% and 38% respectively in 2022 and 2023, setting the stage for a home price index drop exceeding 14% from quarterly peak to trough in both provinces. The magnitude of the downturn would rival that of the early 1990s in Ontario, when resales fell 41% and prices 15%, though they came well short of the early 1980s episode in British Columbia, when resales slumped 62% and prices 27%. They said, while we project resale activity to cumulatively decline more than 20% in every other province from all-round record levels this year and next, we think prices will be more resilient in the more affordable regions of the country. They project prices to slip less than 3% in Alberta and Saskatchewan, and between 5 and 8% in the majority of other provinces by the first half of 2023. So this is, they say, a correction, not a collapse. The Bank of Canada's more aggressive course has clearly dimmed the outlook for Canada's housing market. They think both activity and prices are set for a material correction, but we'd argue the unfolding downturn should be seen as a welcome cooldown following a 2-year-long frenzy that put a huge financial burden on many new homeowners and made ownership dreams harder to achieve. While a more severe or prolonged slump can't be ruled out, they expect the correction to be over sometime in the first half of 2023, lasting approximately a year, with some markets likely stabilising faster than others. Solid demographic fundamentals, including soaring immigration and a low likelihood of overbuilding, should keep the market from entering a death spiral. So, in summary, rising mortgage rates could put even more pressure on affordability, and they expect one measure of housing affordability, the cost of ownership as a percentage of household income, to reach its worst level ever, forcing many buyers out of the market, and that will send more buyers to the sideline. They expect the downturn will deepen in the coming months, with both resale activity and home prices reaching lower levels than they previously anticipated. But they say this is a welcome cooldown following a 2-year frenzy that put the financial burden on many new homeowners and made home ownership dreams harder to achieve. But it's always hard to forecast how far things will go down in the middle of a correction. And I think that they may have to revise their forecasts further ahead, because those interest rate rises will flow through and quickly and will dampen the markets. Now, if we come back to Australia, I think we can see the same here, which is why, by the way, I run 3 different scenarios. A best case scenario, which is that everything turns quickly and inflation gets under control and rates then are dropped quite quickly. And if we see that, then the overall damage to the market would be quite low, but it would still, of course, leave values at a very, very high level relative to absolutes, both in terms of GDP and income. The base case scenario is a fall of somewhere between 20 and 30%, which would at least take the heat out of the market over the last couple of years, but would still leave the markets here ahead of where they should be based on the long-term averages, and still leave people with big affordability headaches. The worst case scenario is a fall of closer to 30 to 50%. Now, if we got into that territory, we would then be seeing home prices coming back to their long-term averages. And that would mean that both in terms of affordability to income and also the relationship between prices and GDP, we would come back to long-term trends. Now, of course, the sort of wealth that's been created, which has been artificially created over the last couple of decades, would be dissipated. But is that really a bad thing? Because we would then be back on a fundamentally more level trajectory ahead. But I think the takeout from today's conversation is this. Whatever you think about who's pulling the strings, whether it's globally or locally, in the short term, many homeowners are going to lose value, theoretical value, paper value, on their overpriced properties. But that may not necessarily be a totally bad thing, because we might actually get back to a more fundamental level of property. And by the way, it means that first-time buyers could then begin to think about entering the market at a reasonable point in the cycle, rather than what's been happening over the last few years, where governments have artificially stimulated the property market by bribing first-time buyers in to pay very, very high prices. But of course, the fallout is very significant loss of cash flow for many households and a significant bout of negative equity. And it is worth just thinking about this. Negative equity, of course, creates a problem later, insofar that it blocks people from moving and makes it very difficult to shop around for the cheaper mortgages ahead. So you can stand back and conclude that the last 20 years has been a bit of an experiment in inflating house prices. Well, we'll speculate another time as to why that might be the case. But the fallout is going to be significant, long-term, and very painful. And you can't expect central banks to stop lifting rates anytime soon. So hunker down and adopt the brace position. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.